Introduction to stock chart patterns. Transitions between rising and sliding trends are frequently indicated by stock chart patterns. Using a sequence of trend lines and/or curves, one can identify a price pattern, which is an identifiable configuration of price movement. A continuation pattern develops when the trend continues in its current direction after a brief pause. A reversal pattern emerges when a price pattern signifies a shift in trend direction. There are numerous patterns that traders use. Here is how some of the more well-known patterns are created. Technical analysis. Trendlines. Understanding trend lines and being able to draw them is useful since pricing patterns are found utilizing a sequence of lines or curves. Technical analysts use trend lines to identify regions of support and resistance on a price chart. A succession of descending peaks, highs, or ascending troughs are connected to form a trend line, which is a straight line on a chart, lows. Where prices are experiencing higher highs and higher lows, a trend line that angles up, or an up trend line, is seen. Connecting the ascending lows creates the UP trend line. In contrast, a trend line that is angled downward and is known as a down trend line appears when prices have lower highs and lower lows. The body of the candle bar, rather than the thin wicks above and below the candle body, frequently represents where the majority of price action has occurred and may therefore provide a more accurate point on which to draw the trend line, particularly on intraday charts where outliers, data points that fall well outside the normal range, may exist. There are various schools of thought regarding which part of the price bar should be used. Chartists frequently create trend lines on daily charts using closing prices rather than highs or lows because closing prices reflect the traders' and investors' willingness to hold a position over the course of a day, a weekend, or a market holiday. In general, trend lines based on 3 or more points are more reliable than those based on only 2. When prices make higher highs and higher lows, an uptrend is in motion. At least 2 of the lows are connected by upward trend lines, which display support levels below price. When prices make lower highs and lower lows, a downtrend is in motion. At least 2 of the highs are connected by downward trend lines, which show resistance levels above the price. Consolidation, often known as a sideways market, is when price fluctuates between 2 parallel, frequently horizontal trend lines. Thanks for watching.